The market doesn't care that you don't have easy, safe investments to make. And your desperation is your own matter. What it does is focus on the difference between short-term and long-term. On the short term, you can say, I'm offered nothing by fixed income. I get something out of stocks, even though it's half what it seemed to be in the yield. It's still better than nothing, therefore I'll do it, and the prices rise. And that is a logic that you hear one way or the other all over the place. And then there's the argument in the long term, which is, in the end, all assets equal replacement cost. House prices go up, but if you can build one at half price, you put a ceiling on it. If you can create a new company at half price. I am a great fan of venture capital for this reason. I've spent my entire life fighting the Fed, frankly. What I will say is this, that typically the Fed wins many more rounds than we have. But in the end, we've had a knockout. In the end, the Fed has not been able to keep the tech bubble going indefinitely. It sent it over the 21 times earnings of 1929, it sent it up to 35, but it couldn't go on indefinitely. Even Japan, that went to 65. The price they paid when you finally knocked it out is here we are, 31 years later, not even faintly close to the high of 1989. If you go into their real estate market, which was an even bigger bubble, I think the biggest bubble, including the South Sea bubble ever, or tulips, they went down for 30 years, and now they're bottoming out, maybe. But they're bottoming out in central city prices at a quarter of where they came from. The land under the Emperor's Palace in 1989-90 was indeed worth the state of California, to give you some idea. But we spent a day or two checking it out. It really was true. And the price you pay for that is you could be 50 years later and still not back to that level again. I would say don't fight the Fed if you're a short-term player. But if you're a long-term player, you have to be prepared to fight the Fed on occasions. As long as inflation is not really gathering steam, when you find yourself facing a slowing global economy, you have to kick it in the tail. And it needs massive government stimulus on a sustained basis. A few years ago, I debated Jim Grant, who called me an apostate amongst value managers for hedging about this time is different. I maintain that the four most dangerous words, this time is different, should be replaced by the five most dangerous words, which is this time is never different. That is a very dangerous idea to think that you can never have important permanent changes. And I think almost everything has changed since 2000. So the certainties that we used to have no longer exist. But that was 5 years ago. That was before the most massive move against value. On any way you care to measure it now, we're off the scale. So I don't think a value is as dependable and useful a weapon as it was for 70 years prior to 2000. But I think it's a very handy weapon when you push the parameters so far that it hits historical lows against growth stocks. So we may not snap back 120% I would have calculated 20 years ago, but we are going to have a very big reversal in favor of value stocks sooner or later. I think we can be pretty safe about that. And one of the things comes down to the nature of the facts. I don't recommend necessarily going short, but I do recommend owning as few US equities as you can face. Emerging equities, emerging markets are not only at an unprecedented low relative, but they are actually quite cheap, absolutely, compared to the US on their own. And who are they? They're China, who is going to represent, according to the World Bank, over 30% of the entire world's growth over the next 20 years, and India, which is going to be an increasingly important player. And then you have the Brazils and so on. Collectively, they are much the bigger part now of global GDP. These things move very fast. I think a bet on emerging markets is really betting the future against the past. And the only thing that makes life interesting outside emerging are the FANGs. Intellectually interesting, but when they've gone up 10 times in a hurry, you have to say it's intellectually more interesting than it is financially interesting.